with me the Group Chief Executive of Vedanta, Tom Albanese. Thanks for your time.
Great to be here today.
Talk to me about the transition from Rio Tinto, you left in January 2013, to Vedanta Resources.
Well, first of all, I've been in the mining industry now, counting this year, 40 years. I didn't really, so I talked to my kids about this. So I've been, watching this business, and I've been growing with the business as we go forward. I had a phenomenally great time at Rio Tinto, and I grew my career in predecessor companies to that. Over the past 3 years, using all those learnings and all the lessons from that, basically taking Vedanta, which has been a very fast-growing Indian resources company, and basically creating a vision of a series of global businesses that are going to primarily feed the future requirements of the future Indian economy. So it's just been a lot of fun. It's been really a smart group of people in all levels in Vedanta. I found that there's over 10,000 engineers in the company. They're very focused. The average age is 32. Everyone's internet savvy, move very quickly, very adaptive. We've gone through some difficult times.
And Tom, you talk about a high-growth company.
Yeah.
How does that fit in with the tighter financing environment that we're facing right now? Have you experienced headwinds?
Yeah, what we've had to do, we've experienced the headwinds. What we've had to do is to focus on the fact that we've had low-cost assets. We've spent most of the capital costs over the past couple of years before I came on board. So what we had to do is bring down our capital cost, focus on bringing down our operating costs. We had a lot of capacity that wasn't yet up and running, bring that capacity up and running, and just boring stuff like increasing cash flows, improving our working capital in the absence of monies from the capital market, making do with what we can generate ourselves. And we've done a very good job at that. So that's positioned us. Now we haven't grown as much over the past 3 years as we would have grown over the 10 years before that. But I think we've created a stronger platform. We've certainly kept our options open. The markets will recover, and at that point in time, like we're seeing in some of our projects this year, we will begin prudently expanding where it makes sense.
The tighter financing conditions are one thing, but key to your business is obviously the fallout in the commodity space, in the resource environment. Where are we going?
Well, again, 3 to 4 months ago, we were all gasping for breath with $4,000 copper, with oil below $30 a barrel, with zinc down at $1,500. So we're all sort of breathing a little easier now. But this recovery has actually been very rapid. We've seen some of our commodities like copper and aluminum have gone up 15-20%, but some of them like iron ore have gone up 100%. I would guess that these moves are probably a little bit too fast. So they're a bit overdone.
Does that mean volatility?
I think we'll continue to see volatility. I wouldn't be surprised if we see some retracements. I think the markets are going to watch very closely what's happening in China. They're going to watch very closely what the Federal Reserve in the U.S. does. In June, are they going to add another notch to the interest rates? Those will probably all create space for some room for retracement across the sector. But I'm hoping that the lows we would have seen back in January, December will have been the lows of this cycle.
In other words, don't bet the kitchen sink on these new commodity prices.
Or I would say enjoy these markets while we got them.
Let's talk about China and your prospects for that economy and how it's going to continue to impact resource players.
Look, I've been involved with China and China's growth story for almost its entire cycle. And what we saw was we were surprised on the upside when the markets were beginning to get very strong, and we also began to see the average per capita GDPs getting up into that $7,000-8,000 range. Everyone was correctly assuming that those growth rates were going to need to start flattening out. Their 5-year plan said they need to slow down, and that's exactly what we've seen.
This is a manufactured slowdown of the Chinese economy.
Yeah, I think it was a planned slowdown, manufactured slowdown, but it's also, I believe, is transition from an industrial growth phase to a post-industrial growth phase. I think that the problem that China has is its information is not very transparent. People don't trust the numbers. And if people don't trust the numbers, they fear the worst. And because of that, people have been fearing that China, as it's slowing down, is going into a hard recessionary landing. And I think that had spooked the markets, and we certainly saw that playing to our
Do you think the situation is worse than what is being projected by Chinese authorities as we speak?
I would guess that it's probably moderately subdued from that, but it's not horribly worse. And my view is that 5 years from now, people will have seen its transition from a manufacturing-led economy to a services and next-generation IT and everything else, internet-based economy, and they'll say, how fast did they do that? Because I think that they will have created that post-industrial economy at the same accelerated rate that they had created their first stage of their industrialization.
You're obviously a good barometer of what is happening in India, given that Vedanta originates from India. A fast-growing economy, can it hold its own? Are we going to see faltering?
Well, the only reason it's seen as a fast-growing economy because all the other bricks are not seen to be growing at all. So I think what we have is it's a relative game. And so we have 7 to 8% GDP growth. Those numbers themselves are boosted up about 0.5% or so because they changed the way they calculate the GDP numbers. So they're basically modestly boosting their own picture. But what we've seen is that for our businesses, for the primary metals components, they've also been growing at single-digit rates. And we would expect at some point in time, if the Indian economy can continue its progression, if we see some more manufacturing coming into the country, if we see the country itself investing more in its infrastructure, we would expect that 7-8% GDP growth could continue for another 10 years or even more. And at some point, there'll be a tipping point, as we've seen with other economies like China, like Japan, like the U.S. before that. You'll see double-digit growth for the metals and and basically the commodities during that period.
So you're going to enjoy buoyant demand from India.
We would expect that. Now, I don't think it's going to be as fast as the buoyant growth we saw in China. I don't think it's going to be as robust as that. I think just India is so different. India, it takes so long to get things planned. You have the very vibrant democratic process, which means nobody agrees on anything. So you're not going to see sort of the coordinated spending on projects across the board like we saw in China. It will be a slower pace, but I think it's going to happen.
When you look at the landscape that Vedanta straddles, what keeps you awake at night? What could change the demand-supply equation as we know it right now?
What keeps us awake at night is how well is China going? Is China in a soft landing mode where it's still growing at roughly 5 to 6%? The government may say 6 to 7. It's probably somewhere between 5 and 6. Or is it in negative numbers?
Distilling what you were saying earlier, I'm assuming that you think it's going to be a soft landing. It's not going to be as hard as some pundits out there are making it to be.
As a pundit myself, I've been saying a soft landing for a good part of the past 4 or 5 years, and so far I think it's on that track.
Let's talk about Africa and the fact that you are present in 4 economies on the African continent, namely Liberia, Zambia, Namibia, and South Africa. I want to bring it right home. What are your thoughts around stability, policy stability, particularly in South Africa right now? Have the risk levels escalated for you?
I think that in general, on balance, the risk levels have increased over the past several years in South Africa. And that's been evidenced by the fact that you're not seeing so much foreign direct investment coming in the country. You've seen a weakening of the currency. So the factors, the KPIs that people would look to see how is the economy doing would be pointing in that direction. We are investing in South Africa as we speak, so we still see opportunities in South Africa. As a matter of fact, the weaker currency is one of the drivers causing us to be investing in South Africa at this time. I do recognize...
Does the currency volatility not worry you terribly? Because it's very difficult to judge where the rand is going to be a day or a week from now.
Well, we have not only volatile currency, but we also have volatile metals that we're going to be selling it to. So we have double volatility that we have to base our project evaluation on. So that means we have to be quite conservative in our assessment of both commodities and also the currency as we think about making investments. But I would say there continues to be the same social imperative in South Africa that's existed for now more than 20 years. And that social imperative is continuing. You've got to see wealth distributed under a broader-based grouping of people in South Africa across the board. Part of it's black empowerment, but part of it is high levels of poverty. So you have to increase the broad-based nature of the wealth in the country. And that's a social imperative. We recognize that, but it's got to be done in a way which continues to make the country attractive to foreign direct investment. South Africa remains the best infrastructure
and mining is a long-term game.
It is a long-term game. It's a long-term game.
It's a long-term commitment.
But I've been all over Africa, and South Africa still has the best roads. It still has the best power. It still has the best IT connectivity. It still has the best Wi-Fi. So it still is the best positioned in all of Africa, bar none, for its infrastructure. And it has huge capability in SMEs that have been just sprouting up over the past 10 years. There's more of this to come. There's a great service sector in the country. The mines have been part of the catalyst to get this capital and the infrastructure going. You need to see more mines. You need to see now another generation of investment into the mining sector. I think mining has been capital starved for the past 10 years.
There are those that are saying mining in South Africa is a sunset industry.
I'm an exploration person. I've done a lot of exploration in my career, and I believe that South Africa continues to be underexplored. There are more resources to be found. So, while people are thinking about, well, this mine's been around 50 years, I don't know how many years it has to go on it, there could be just across the fence another undeveloped property that's there waiting to be found. So I do believe that the policymakers should continue to focus on what would drive more exploration, what would drive more R&D, what would drive the creation of the next generation of resources, because that will bring in the next generation of capital.
Tom, let's talk about regionalization, given the fact that you, as I mentioned earlier, are present in Namibia and Zambia, in the southern African region. Let's leave Liberia out of the equation. Are you benefiting from regional power plants, from regional initiatives?
We are, well, first of all, I think we found that the relationship between Namibia and South Africa is very strong. And that has allowed us, as we look at our developments in South Africa, in the Northern Cape, and also our project in southern Namibia, which is a mine that's been around for a good part of 25 years, we find that the next generation of growth for these these businesses will be by exploiting synergies across the border, i.e. we will be developing resources in the Northern Cape that we will be sending to Namibia for refining in existing facilities that we'll be putting new technology in. So we'll have an basically a finished zinc product that we'll be exporting from there. And that exists because of the fact that there's a geologic region of zinc that crosses the border. And if we can continue to make those two businesses work together rather than opposed from each other, everyone's benefiting from that. Now, again, the power in Namibia comes from South Africa. So again, we look to South Africa for its power, and over time, I think we need to see more regional cooperation on the power business. I think because the weakness in the South African economy, you haven't seen as much talk about the power shortages in South Africa as you would have seen 2 years ago. There's a bit of a short-term holiday period for power in South Africa. I think that it's important.
Are we over the worst, in your view, as an international player in the South African environment? Do you feel that the worst is over with regard to the power deficits?
Well, I think that they can return, because as the South African industry and its economy improves, it will consume the power that is now creating a small short-term surplus.
And we haven't
so
been
it's
able
up
to revamp the infrastructure.
to South Africa policymakers and attracting capital to basically work now proactively to avoid that deficit from happening again.
Just a final note on Liberia. Operating in that environment, does it differ dramatically from what you're seeing in Zambia, Namibia, and South Africa?
I think that they have done a fantastic job in Liberia. The country's leaders, I met the president just a few months ago. She's done a fantastic job in an incredibly challenging situation. One of the toughest civil wars the world's seen for several decades took place. As they're recovering from that, bang, Ebola hits. So you've had a sort of series of very, very big problems taking place. The country is very well endowed with natural resources. It's on the coast. It has a very good access to world trade, and has people that want to live better.
Tom, thanks so much for your time.
Thank you.
I've been chatting to Tom Albanese, who's the Group Chief Executive of Vedanta.